What's up, guys? I got a request to look into Reckitt Bankster Group, or Benckiser Group, I guess. And so that's what we're looking at today. I have them pulled up on the over-the-counter markets because I'd rather work with the US dollar than the British currency, the pound, you know. So we're taking a look at this. Here's a 5-year chart. This isn't the type of chart that I really like to see. You can see that it's been going down, and then just recently it kind of fell off a cliff. I heard it has something to do with lawsuits, but even without the lawsuits, I still don't really think that this is a great company to buy into. But we'll go through the numbers, so don't worry about that. This is a $40 billion company, so pretty decent sized company. 4% dividend, a 23 price to earnings ratio. Here is okay, let's check out their financials real quick. Their statements. Let's zoom this in a little bit. Here's their revenue, and their revenue has been pretty much flat for the past. Oh wait, well it grew a little bit here. Well, okay, we could say that it's probably growing at like 2 or 3% a year for the revenue, probably just keeping in line with inflation. Then we've got their net income right here. It's kind of all over the place. Let's see. Okay, here's their gross profit. Their gross profit's kind of gone up, but right here, look at this number. Their operating expense has gone up by a lot in the last year, and so it really hurt their operating income. And that also hurt their margins. Checking out their balance sheet, they have a lot of debt. This is their debt, 9.1 billion in debt. It's a lot when their income is like 2 billion. So it's a pretty decent amount of debt. Cash flow follows earnings really close. Except for like the negative 2 billions. Yeah, there's no negatives in their free cash flow. And they pay most of it out in dividends. They paid 1.6 billion in dividends last year, and they haven't really been doing much with the stock. It says they bought back like 200 million in stock, but I don't really know if that's going to continue. Maybe it will. In terms of statistics, let's check out their profit margins. Return on invested capital right here is underneath 15% every single year, and their net margin right here, 5% in their most recent year. But I calculate their net margin at about 10% every single year on average. I would say 10% would be fair for this company. So let's go through one of their a couple of their slides to understand their business model. And this is it. They sell hygiene products and like Lysol, lots of dishwasher stuff. Yeah, like consumable products that everybody needs. So this company is not going away anytime soon. It's a competitive business. Most people are not really loyal to the brands either, so I don't know if this company really has that big of a moat. That's something to watch out for. They're painting a pretty rosy picture with like, oh, plus 11% in these categories. Well, they've got a lot of different products. We don't really know how much these are generating for them, so I won't put too much stock into that stuff. They've just got a lot of like feel-good slides that don't really tell us much, which is really annoying. Yeah, they've got their numbers here. We already went through those. Let's go to the discounted cash flow model. And here I put it in. I put an EPS estimate of 60 cents and their revenue estimate of 18.5 billion for next year, which is pretty much flat compared to last year. And then buybacks of 0 and net debt of 9.1 billion. Discount rate to 10% because I want a 10% return. Exit multiple of 18. I do feel that is fair for this company. It might be good to go even lower with the exit multiple because they don't really have much of a moat. For earnings growth, I put 6%. I'm not quite sure if that's fair for them. It maybe should be like 4%. because they don't really have like growth drivers in this business. But if we had 6% earnings growth, then their fair share price would be 11.42, which is literally like exactly what they're trading at right now. So not bad, but after you count their debts, then it drops all the way down to 8.86. In reality, it's probably somewhere in between these two numbers. And if we do it with revenue growth and profit margins, I calculate their revenue growth at about 3%, just keeping in line with inflation. And their profit margin was 6% last year, so I think 8%, and then their historical average of like 10% for the rest of the years is fair. And with that assumption, then their fair share price is at $8.34, and after their debts is $5.77. So I think I might consider buying this company at like $8 a share, maybe like $7 a share, but definitely would not buy them at this price. I don't think you're going to be able to see a 10% return with this company moving forward. Especially if you look at the chart. The chart's pretty bad. Maybe if you're expecting an 8% return. Oh wait, that's 80%. My bad. An 8% return doesn't quite get you there on the revenue one. Maybe like a 5% return. A 5% return gets you there, pretty close. So yeah, I'd say if you bought it today, you'd be expecting about a 5% return moving forward. So that's the reason why I'm staying away from this stock. So if you guys have any questions, leave them in the comments. I also let you guys use this for free if you just check my description. You can try this spreadsheet out completely for free. And hit that like button, hit that subscribe button, and I'll see you in the next video.